All right, I'm live again because I have some questions coming in. If you have any questions, you email me. I will keep you anonymous and I will answer your personal finance, military, political questions for free with a live video, okay? Shoot me an email or drop me a comment and I'll answer your questions. So I got another email from a guy, and I'll call him Mr. B. I don't know if he wants to be anonymous or not, but he's a government employee and he has some questions about where to put his money for investments and whether he should do the Roth or the traditional TSP. So he says, hello, fellow veteran. I'm now a government employee, which he's a GS7, which is like the GS scale. There's different grades on there. There's GS 1 through 15, and each one of those denotes more responsibility and more pay. So when you first start working as a government employee, you're going to be in the low GSs. Like I was a GS6. And then over time, you're going to work your way up the GS scale. So he's a GS7. It looks like an entry-level job. And eventually he'll cap out somewhere else. So he says, I would like a reply or a video, whatever works for you. So he says, in the TSP, I'm currently only investing in L funds, the 2050 fund, which is fine by me so far. Can you please clarify which fund is the World Fund in TSP? And he says, I know that I is international, but not sure if you're talking about the C fund. What is your recommendation for proper allocation for the TSP? Well, ultimately, your asset allocation is up to you. My advice is when you first start investing in your TSP, you want to pick an L fund that closely matches your retirement date. So you're at least investing your money, and you're investing your money in broadly diversified mutual funds that cover as much of the world as you can possibly get. Then you go to bogleheads.org and you learn about asset allocation, and you learn about how you shouldn't time the market and how you should own as much of the world as possible and let the world sort itself out instead of trying to chase performance and buy US when US is done good and then buy international when international is done good. So that's my recommendation. Right now, you're fine. The L fund is great. Now, when it comes to the total world in the TSP, when I talk about a total world investment, Vanguard actually offers, which is another company that it's not affiliated with the TSP. They offer an ETF called the VT ETF. And that ETF actually invests or is designed to track the performance of all of the world's stocks in one location. Now, the TSP has something equivalent. They have three different stock funds. They have the C fund, which is the S&P 500. That's the largest 500 companies in America. And then you have the S fund, which is the remaining companies in America. So with the C and the S, that's basically a total US stock market index, as long as you combine them in the right weights. Now, keep in mind, the C fund in the US, the S&P 500, makes up like 80% of the market cap of all the stocks in the US. So a ratio of like roughly 80% C to 20% S for your US allocation roughly tracks the entire US stock market. Now, the I fund is international. The only downside is I believe the I fund only tracks like the stock markets of European stock markets and Japan and Australia and a few more. It actually, I don't think it covers a lot of emerging markets like China or, Brazil, Russia, India. So they're kind of exclusive with the I fund. They basically let you invest with like some of our traditional allies. So in the TSP, you're not going to get a total world allocation. But at least with the I fund and the C fund and the S fund combined, you're going to capture most of the world, just not all of it. So if you want to invest in a total world, you want to do an L fund. And then once you do your research, if you don't want to invest in any bonds, which are the G fund and the F fund, then you can determine your own asset allocation, splitting between the C, the S, and the I. And that captures as much as the world as you're going to get in the TSP. Now, you may look at the I fund and be like, well, the I fund's kind of sucked recently. Well, guess what? That's how the market works. There may be decades where one fund sucks, and there may be decades where another fund does extremely well. But that doesn't mean you sell the sucky ones and buy the good ones, because over time they reverse. Sometimes international stocks do really well. Sometimes US stocks do really well. So in that case, sometimes C and S are going to do really well. That's the US. And then you might have I. That's, Europe, Japan, whatever. Sometimes they'll do better than the US. So instead of trying to time it, own them all and hold on to them. And then if one gets too big, you can kind of trim your holdings and then buy the other one that's at a low. And the L fund does that for you. That's why I like starting with the L fund. And then you can go to Bogleheads and read more about it. And then he says, okay, Roth or traditional? I started my TSP at Roth, but changed it to only traditional due to fear of government changing the tax treatment and taking the Roth by my retirement. Can you talk about the chance of this happening? I saw your video and you recommend maxing Roth than traditional. Would like to hear your opinion on this. Well, if you're a GS7 man, and I'm on a GS9 right now, if you're a GS7, you're not making that much money. And in that case, you're actually in a lower tax bracket than you probably will in retirement as long as you're saving diligently. So the question you want to ask is, am I in a lower tax bracket now, or am I going to be in a lower tax bracket in retirement? Now, based on our government's fiscal policies, I think they're going to raise taxes in the future because there's so much debt and there's so much stupid spending that, yeah, to me, it seems inevitable that they're going to raise taxes. So we're actually in a kind of historically low tax rate environment right now. So if you're paying low taxes on the front and you think there's going to be high taxes in the future, it's better to do the Roth. And that's especially pertinent if you're like a GS6, 7, 9, whatever, because you're not making that much money. So I recommend the Roth. And on top of that, when you get your TSP match, if I'm not mistaken, the matching portion actually goes into the traditional. So you're actually getting a little bit of traditional exposure as kind of like a backup in case you're wrong about your tax estimates. So I would say do the Roth as much as you can, or at least get the match. Then you go and max your Roth IRA, where you can buy a total world stock market index that includes emerging markets. And then once you max your IRA, then you can come back to the TSP and then put as much as you can there. So I think you should keep doing the Roth. Ultimately, it's your decision, but I think they're going to raise taxes in the future. And will they possibly penalize, Roth withdrawals in the future? If you have too much money in your Roth because you're evil and you save money, it's possible. Anything's possible. But based on the information I know right now, I see higher taxes in the future and I see lower taxes now. And I'm going to act on what I think. I can't predict the future. So I have a little bit of TSP and traditional. That's my matching. And then I have a lot more in Roth. So I can't predict the future, but just based on what I know, I think the Roth's a better deal right now. And then as you move up the GS scale, maybe if you're a GS 15 and then they raise freaking taxes on your current income, well, maybe at that point, then maybe you want to look into the traditional. It's all up to what you're paying now in taxes and what you expect to pay in the future. All right, WGU, can you tell me how the master's program in accounting is? I'm not sure if I really want to go for my master's. I got an accounting bachelor's, but I have not used it yet. I joined the Navy after I graduated. Now looking into a master program and maybe a CPA. Well, here's the deal. The WGU master's program for accounting, it's pretty good. I can't complain about it. But the thing is, I got the CPA before I got my master's. I work for the government. They don't really care about the CPA. They more care about your master's degree. That's just how it is. Maybe your workforce is different. So in my scenario, I had enough credits because I actually have 2 bachelor's degrees to sit for the CPA exam. So I passed the CPA and then I said, oh crap, now I need the master's. So I'm just going to the master's at WGU because it's cheap. So if you don't have enough credits to sit for the CPA exam, usually it's 150, and you want to be a CPA, which I highly recommend because you actually make good freaking money. You have a viable skill that people want to pay for. I would say get the master's at WGU. It's the best deal. It's so cheap. You can complete it at your own speed. You can complete it in 1 semester if you want to. I'm just dragging it out because I get the GI Bill and I'm getting paid BAH. But I would definitely recommend it. You finish at your own pace. The stuff's fresh in your mind. And then you can immediately go and start studying for the CPA exam. And if you get that CPA, you're freaking set. And then he said, for a single person, you need to bother with life insurance. Generally, no. The only caveat is with life insurance. If you think you're going to get married in the next couple of years, there's a risk that, let's say you develop a health problem next year, right? Let's say you have something wrong with you and that makes you uninsurable. Well, if you don't have a life insurance policy in effect at that time, and you now have this health problem, and then you get married, well, you might have a harder time qualifying for life insurance. Now, the government does give you life insurance through FEGLI, so you could be fine. They might not care what your health condition is. But if you're looking at maybe the private sector and you're worried about some health problem, maybe your family has it, and you think you might get married the next couple of years, maybe look into it like a 30-year term, but that's really your call. I didn't really jack up my life insurance until I got married and I'm having a kid. So at that point, I was like, okay, I'm getting life insurance. But right now, I mean, it's not going to kill you, especially if you have FEGLI. But, that's something to consider. Maybe you'll develop a health problem before you get married. So that's that. I don't see any more questions. So yeah, I would say stay with the life cycle fund. You basically own as much as the world as you can. You can't own the entire world in the TSP because they exclude like China. Like our government doesn't want us to invest in Chinese companies because they're kind of corrupt, but whatever. I would keep doing the Roth. You get the match and the traditional, but at the end of the day, that's your choice. And then I would definitely get the master's in accounting if you want to get that CPA. And you want that CPA because you can make a lot of money on the side. Like people pay me a lot of money to tutor. And I'm just some guy with a CPA. I don't even have a master's degree. And you can do a lot of stuff with a CPA. So I would definitely get it. I would definitely do it. WGU, Masters of Accounting. So that's that. Any more questions? I think I'm going to do one more video. If you know people that need my help, tell them about me. I'm trying to grow my channel, okay? So make sure you're liking the video, commenting, subscribing, sharing to all your friends, all right? I have one more video I'm going to make, and then I'm going to go back to work because I'm on my lunch break, and I'm freaking hungry, all right? See you guys in about 5 seconds.